Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith. So, in keeping with the theme of looking for loyalty or knowing whether or not you've got any support and trying to avoid a surprise that really shouldn't be much of a surprise, I'm going to focus this week's Market Outlook on whether or not traders and investors should anticipate that it is safe if the market continues to pull back into these areas of support. I'm going to get into those in a minute. Or whether or not the market really doesn't have the support that it needs and it's forming that dreaded top that it seems like everybody's looking for. All right, so in order to do that, I'm going to take a look at a couple of the indicators we normally look at, but I'm going to focus on just a few to assess essentially whether or not there is the possibility of a hidden defection by the bulls if the market gets weak. If the market continues to move higher, it's certainly not overbought, and we'll see that in a second by some basic measures. And that means who knows where this thing can go. It's definitely long overdue for a correction, but traders who try to sell tops generally get hurt. So I'm not going to be one who's going to try and predict the top. I'd rather predict whether or not a pullback is safe. And so here's how we want to do that. First, let's take a look at some of these individual stocks, individual markets a little more closely. Let's start with the SPYs because the SPYs have really been the leader, and the SPYs have really demonstrated a nice looking breakout and move away from the highs that have kind of plagued it for the entire year until this move up. So again, the real question is whether or not it's safe to be a buyer on a pullback, which I believe that everybody who says they hate this rally is really looking for that opportunity. And technically, if we were to come back to this line, this 190 level, it would represent a confluence of some really significant levels. Not only the three good highs put in, but this magenta line here is the 50-day moving average, so that'll line up. You can see that these trend lines will also line up in that area, and if I blow this chart out, you can see that even though the trend line's a little fudged, it's got some good hits here, 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 and all the way down to these lows in October, November of 2012. So a pullback to this area would be a major inflection point, and for me, I'd like to anticipate as quickly as I can whether or not that's something that should be bought or it's an indication of a major breakdown. So if we just look at the other indexes from that same perspective, let's take a look at NASDAQ. Right now, the Qs here have broken out to new highs, and those two have a really interesting zone here around the 91 level if we pull back to that level. Just basic, but oftentimes I find basic to be the most powerful levels of support based on the breakout. And let's take a look at the Dow. And the Dow looks similar to the S&P, but the Dow kept creeping up a little. So these areas in here where we pulled back to, this 167 level, makes sense for it to hold. It's not really that much of a pullback, and I wouldn't be surprised really to see this level in here, this zone, of about the 166 to about the 165 and a quarter level be a more reasonable zone to see it pull back to, and this again is the 50-day moving average. So the wild card here is really represented by the broader indexes. I'm going to start with the IWM, which have not made new highs. Okay, and that's what a lot of traders are focused on, should be focused on, that while the SPYs have chugged right along, the broader indexes have struggled. Now let's take a quick look at this big trend line here, because this is problematic from a technical point of view. This is a significant trend line, again, going all the way back to November of 2012, lining up with the last major decline the IWMs have seen. And we broke the trend line and have now rallied back up to kind of do a back kiss here, which, if this holds as a high, is technically a very bearish indication. What makes it even more potentially concerning, which you can see already illustrated on the chart, is that that high lines up with a very obvious area of resistance. So IWMs, for the bulls case, longer term, really do need to demonstrate that this isn't a high in here. And so for me, the big picture here is that they can trade in this zone while they decide whether or not they're going to move higher. But if they break lower, that's a big negative. And just looking at the big picture, that's what I'll be watching out for. And that on top of this underlying strength or support we're going to look at in just a second. One final chart that also represents the broader measures that is a bit of a concern is the NASDAQ composite. So this, while not as weak as IWMs, also has some very interesting big picture patterns. Has the same back kiss potential pattern from a more accelerated trend line. You can see this trend line in here, which began around June of 2013, lined up with the correction earlier this year. And then again, we've been unable to get back up above it, but not only unable to get back up above it, really stopped right at it, and it lines up again with a significant and obvious level of resistance. So the zone here in the composite, I would describe as, again, this level here and this level here, and keeping in mind we were unable to get above those highs, even though the Qs were able to get above the highs. So in short, we do have a early scenario which is suggestive of the market's rally is becoming thinner and thinner, i.e. fewer and fewer stocks are making new highs as the index appears to be making new highs. They're not all making new highs. Now, this divergence can be a major sign of a longer term top, or it can work itself out and the markets move higher. So with that in mind, you want to be really careful about whether or not you buy these corrections, and that's why I'm going to focus on that right now. So let's take a look at what the internals of the market look like. Okay, so I said earlier that the markets were not overbought. So I'm basing that on some basic indicators that we look at almost every week. And the first there is the McClellan. So the McClellan oscillator looks at the advanced declines and determines whether or not the markets have just gone too far too fast in terms of a market breadth point of view. Now I want to point out that on one hand, you don't want to see the market we don't want to buy into an overbought market. On the other hand, you do want to see markets get somewhat overbought when they make a leg up. And so part of what's a little concerning here with McClellan is that, one, it doesn't show that it's overbought, but it probably should, after this nice move, have moved up higher than it has. All right, so that is one concern. And if we pull back to these levels, we're going to want to see these levels hold and be very careful about the thought that if this gets to be oversold, that we're safe because it's oversold, because oftentimes the biggest declines come from oversold areas. So really, if the market moves higher, we want to see the McClellan push higher. If it doesn't push higher, that'll be a warning. If the market moves lower, we're going to be careful about being too confident that at the low end of the zone means it's safe to buy. And that's primarily because on this breakout, there wasn't a whole lot of follow through in terms of the market breadth. Another way to look at whether or not the market's overbought that we look at frequently is whether or not the market's just plain too complacent, right? And the way we do that is with the VIX. So the VIX, highly publicized, watched very closely as it seems to be melting away down to nothing, did get to our zone of too complacent right about the time the market peaked out for this little pullback here. So the VIX continues to be, I would say, a little too complacent. That said, again, what we want to look out for is whether or not, as the market pulls back, the VIX spikes or the VIX continues to be relatively muted. So a spike really is going to have to take it up above this band, and let's just call it above 13 in a significant way. And then we'll take a look to see whether or not the markets reverse from that point or continue to go lower. So if the markets move higher, we'd like to see the VIX kind of hang out here. If it gets back down to the lows again, the markets are just too complacent to really push too much higher all at once. If the markets pull back and VIX spikes, then we can say we've got some concern, and we want to see that concern, but we also want to see that concern reverse before we get in. So right now I would say the VIX are really not doing us any good until the market moves higher or moves lower, but keep an eye on it when it pulls back. All right, so a chart that probably doesn't get quite as much attention from week to week with us because I just created it here. You can see a chart in our resources area that is this high-low ratio, and I want to point out the divergence that we have between the Qs and the SPYs here in this particular data. What you want to see as the markets move higher, and here's the cash index of the SPYs. The top here is a ratio of number of stocks making new highs over the total number of stocks making new highs and new lows. So this isn't an overbought, oversold indicator by any means. What you want to see in this particular chart, in fact, is the opposite. You want to see this level of 70 be maintained in a bull market, and if you're over this 85 level, it means you've got a really strong relationship, a lot more new highs than new lows. But the other thing you want to keep an eye on with this is whether or not you've got an absolute number of new highs that's driving it, that it's not a really low number of new highs and an even low number of new lows, and you still get the same ratio. Well, in the SPYs, we actually did get a nice push up to the over 300 level, which you can see looking back over time is a significant level of new highs, and that demonstrates that there are enough stocks pushing higher, where market breadth, as I just said in McClellan, was a little undecided, and in fact perhaps saying the opposite. The new high number here in NYSE as we pushed to these recent highs was good. Had it been really low meaning under 150 as we push to new highs, I'd be concerned. But that's a healthy push higher, and so this particular ratio is looking strong. Now starts to head lower, and if it breaks the 70 level, that's the major warning we're going to watch out for. So again, if we pull back to these levels, obviously new highs are going to pull back, but we don't want to see this ratio drop below 70, and we don't want to see a spike in new lows down here. So the other thing I want to point out before we go to the NASDAQ is when NYSE sold off early this year, we didn't really spike in the new lows. Okay, this is what it looks like to spike in new lows. This is what it looks like to spike in new lows. All right, and when you get that spike in new lows, as you do here, you can expect that oftentimes it'll take a little bit longer for the market to digest. Okay, it's a very different picture over in NASDAQ. Now in this case, I've got the composite shown because I want to re-emphasize the fact that we have not made new highs, right? I just covered that. I realize this chart's kind of scrunched up here. But I want you to see the history of the new lows. So in this case, you can see, and remember, NASDAQ took longer to recover and hasn't fully recovered. And part of that could potentially have been foreseen by the fact that when the market did sell off earlier this year, we did get more of a spike in new lows. As the market has moved higher, we're not getting the new highs that we wanted to see. Because you can see in this chart, when you get a higher number of new highs, we're talking about over 200, over 300, right? Those are pushes higher in the new high levels. So I understand we haven't made it to new highs, but the Qs have made it to new highs, and the number of new highs driving that is muted. And when we sold off, the number of new lows was accelerated, or I should say heightened. You can see that in the indicator up here. Now, the levels here are 30. If you get below 30, it's bearish, and that means on one hand it's bearish, on the other hand it means you've also gotten bearish enough that if you turn back up, it's bullish. In much the same way you don't like to see it fall below the 70 up here, because when you do that, you wind up with these areas of weakness that can be more prolonged. So right now, again, this is not an oversold or an overbought reading. This is actually an indication that the ratio is nice and strong. It's not as strong as New York, but it's nice and strong. The thing that I caution about the ratio, however, is that unlike New York, the number of new lows, number of new highs that's driving that ratio is, on an absolute basis, small. This is less convincing than New York. So if I sum up these two charts here, New York is healthy. NASDAQ definitely is not. So let's take a look at one more indicator that we don't typically look at, but I like to introduce a slightly different perspective when I'm filling in for Keith. And this chart is particularly interesting right about now. So again, this is kind of a way to look at what's going on under the market that you don't necessarily see. And it's incredibly powerful and gives you a way to judge whether or not these pullbacks are going to be safe or not. This relationship here is looking at the consumer discretionary versus consumer staples ETFs. And in short, when investors are more confident in the consumer discretionary, this line will go down, and it is generally indicative of a bullish environment for stocks. When the market is more favorable towards the staples or defensive stocks, this line will go up, and the market is generally less favorable for stocks. And you can see how that has worked recently as this line has gone down. This is the IWM. Here are the SPYs. They've basically done well. Now, SPYs have continued, right, to move higher. This is a repeat of what we've been saying. But IWMs have not, all right? Again, a continuation of what we've been saying. And that is not surprising based on what? The underlying structure of what's going on in the market. That while you can't see it unless you're paying attention to an indicator like this, the markets have gotten progressively more defensive, and that has shown up in the action here. It actually showed up in the SPYs. If you think about it this way, it took a long time for the SPYs to break out. The SPYs went sideways. Here's where it gets interesting. The SPYs have now broken out. The IWMs and the composite, the broader measures, have started to move up, and it's done so with a a negative direction in this relationship down here, which is exactly what you want to see. If I could point out a perfect picture for the bulls, it would be that what we've just experienced is similar to this environment in here. Let me grab my pen. Where the market got defensive, the underlying structure of the market got defensive, the broader market went sideways, and even the SPYs went sideways during that time, and then that defensive posture just evaporated, and we went for a long extended period where the underlying structure was much more aggressive to the bullish side. And while it may not have been straight up, the trend has certainly been up. Will that happen here? Well, if it does, we've got a really nice looking breakout, and other technicians will say, well, it was all because of the breakout. And I'm just here to say and illuminate this fact for you, that if this continues, it's going to give you more confidence that this will continue. All right, so again, that's a simple relationship, XLP over XLY. If you have followed what we've been doing recently at Market Gauge, maybe, and I hope you did, there was a free report that we put out about how to look at relative strength. And in that case, we were looking at relative strength rank, and we used that to create some pretty impressive results with our model portfolios in our ETF trading systems. We also suggested in that report that there was another way to look at these relationships between multiple instruments, not just rank them. And in fact, this is one example of that. All right, now we haven't announced it yet, but since you're an Outlook reader, listener, I just want to give you a heads up that later this week we're going to announce another way. It's actually called the triple play. You can see my workspace down here. It's called the triple play trades, and in this particular view of the market, you're going to be able to apply the same kind of underlying structure of trends to individual stocks, and you won't have to rank them all as you do with the relative strength rank that we came out with in the free report. You'll actually be able to pull up an individual stock and see whether or not the strength of that trend is one that you should expect to continue, whether it's breaking out, or whether you expect a breakout to fail miserably because the underlying structure, much like we're looking here at this and seeing the underlying structure change, or we looked at the new highs and saw that the new highs in SPYs, which have continued to rally, were very supportive, but the new highs in NASDAQ, which has not continued to rally, were not supportive. So you can now do that same type of thing with individual stocks. So coming out with that later this week, and it will be called the triple play. So keep your eyes and ears and inbox tuned to anything that has to do with triple play, and I think you'll really like it. Until then, I hope you've had a great weekend, and I hope you are trading well in the markets. And please, if you don't already subscribe to our YouTube channel, please do. You'll be one of the first to get this when it comes out. And if you don't already subscribe to the Market Outlook, you can probably do that on the page that you're seeing this video on. That's all for now, and I'll see you next time.